Hi everyone, it's Adrienne from MB+M here, and I've got Anna here with me. We have had the pleasure of going through the federal budget announcements from last night for your benefit and for ours, and we're just here to give you a bit of an update on sections that will affect the majority of our client base. Anna, lots of interesting things coming out of it.
Yeah, so obviously with COVID, we've had a few budgets that have had lots of incentives for business. That's obviously starting to back off now. So some different announcements this time around.
A little bit of what's ending and what's not continuing on too, isn't it?
For sure.
Didn't get touched on. Yeah. Make a start, and we'll be looking at talking about measures that are ending 30th of June. Some changes to superannuation and some new announcements regarding business incentives that have coming through now. Did you want to kick off, Anna?
Yeah, sure. So the first one that we wanted to have a little bit of a chat about is something that's ending. So the temporary full expensing, which was allowing assets of any value to be written off for tax purposes, is ending on the 30th of June 2023, which is what we expected. I guess the other side that's come out of part of the budget is what is coming into play to replace that. So previously, there was a small business write-off, which allowed assets up to $1,000 to be written off completely. So we haven't gone right back to that. What's been implemented now from 1 July 2023 is a small business write-off of $20,000. There are a couple of factors to be aware of with that. The announcement is that will only be for 12 months, so we're not sure what will happen post that. And it's also going back to being businesses with turnover under $10 million. Whereas the temporary full expensing had been extended pretty broadly so that most entities were available to access it. I guess in line with that, there's some actions that people could be taking at this point in time. If you have assets worth more than $20,000 that you are knowing that you're needing to purchase in your business in the next 12 to 18 months, is it worthwhile bringing forward that purchase to do it before the 30th of June so you can access that temporary full expensing measure? And also if your turnover is over that $10 million, any asset value sort of becomes important to do that by 30 June 2023 if it's not going to impact on your cash flow and you know that you're going to be purchasing it anyway.
Absolutely. And following on to that, what we've been eligible to do for the past 3 years is to carry back our company losses. So if you made a loss in the 2022 financial year, as an example, and you had a profit in the 2021 year, you could actually carry that loss back and offset it against your profit in the previous financial year. So that is ceasing 30th of June this year, which is what we expected, but it does, that has been boosted by being able to expense our full value of our assets in some circumstances. So yeah, that will cease 30th of June.
Yeah, and I know certainly in those circumstances, companies that have been able to access that loss carryback legislation will probably know if they've got some prior year profits that fit into the appropriate periods that are still available, that when they're looking at their trading position for the current year and potential assets that they could claim under the temporary full expensing, there might be potentially a target figure that they're aiming for so that they can utilise as much of that remaining profit as possible. So the next one that we wanted to cover is a new one, so a business energy incentive. So this is looking at businesses with turnover of 50 million or less, that they'll be able to claim an additional 20% deduction on spending, which supports moving away from, for example, gas or diesel towards electricity, and that is creating more effective, efficient energy use. The eligible upgrades need to occur between 1 July 2023 and 30 June 2024. So it's only a 12-month period that this applies for, and there is a cap on it. So you can spend up to $100,000, which will give you a bonus tax deduction of $20,000. And just a reminder there that that's a $20,000 tax deduction, not a $20,000 tax refund. So if you're operating in the company space, it's going to apply at the 25% tax rate. If you're operating in a trust or a partnership, it will be based on the marginal tax rates of where the income ends up being distributed to.
Perhaps an interesting one is that they've announced a small business lodgement penalty amnesty. So no failure to lodge penalties for outstanding tax statements if they were due between the 1st of December 2019 and the 29th of February 2022. So really that COVID period, if you missed out on getting something lodged on time and you've been holding off on it, now's the time to get that sorted, and you won't incur any fines for doing that. You have to have it lodged between the 1st of June to the 31st of December this year. So you've got 7 months to get sorted and get everything lodged. Interestingly, it doesn't come into effect until the 1st of June. So if you have already been getting things together and you're about to lodge, you might want to hold off until the 1st of June to get that lodgement actually lodged with the tax office. And that also applies to those businesses with a turnover of less than $10 million as well. It's a bit of a golden figure.
Interesting that they're moving back to 10 million as opposed to the 50 million and 5 billion, I think it was, that they had in place on a few of the measures previously.
Yep, definitely trying to bring it back down, aren't they?
For sure. So another one that they've put out there, which I think is unlikely to affect many of our clients, but is something that may have piqued some people's interest as part of the announcement, if you just heard a snippet, is the build to rent property legislation that they've suggested they will provide. So at the moment, if you build a new home for residential rental, you get to claim 2.5% of that cost as a building depreciation year on year. What they've announced is that from budget night, effectively, that will increase to 4%. However, the big part of that changes everything is that it only applies to properties that have more than 50 apartments or dwellings as part of it. So if you're just building a rental house or an apartment, you're not going to be eligible. It's more when you're building a complex, which is looking at trying to work towards dealing with some of the social housing issues that are existing in Australia at the moment.
Move on to the superannuation side of the budget. And the first thing is probably the pension reduction. So they confirmed that there will be no further extension of the 50% pension reduction. So that ceases 30th of June 2023. So if your minimum pension was 4% that you had to pull out, and then that got reduced to 2% for the last few financial years, that's now going back up to the full amount, so the full 4% of your pension. So that will have a bit of a cash flow impact on some clients with pension accounts working out their cash flow for the next 12 months. We did expect that, though, to end. So it'll be, have a conversation with your financial planners and your accountants if you're concerned about what that is going to do to your cash flow now.
Yeah. So I guess staying in that super space, there's a few other things, and super's certainly been a little bit of a focus even pre-budget. So one of the ones that was touted a little bit earlier this week, which they have now confirmed, is changes to superannuation guarantee. Now, these aren't going to apply until 1 July 2026, so there's a little bit of time to get everything in order to allow for this. But what they're changing is currently you need to pay your super every quarter. You've got until 28 days after the end of the quarter for an employer to pay the super for their employees. What they're moving to is payday super. So when you pay your wages, whether that be weekly, fortnightly, monthly, you need to pay the super for the employees on the same day. So it will be interesting to see how that pans out.
Mm-hmm. Yeah, that will be an interesting one. And probably just a side note on that is just a reminder that the super guarantee rate actually increases. So quite a few budgets ago, they announced that they were pushing super guarantee up to 12% for employees. And we're on the path to get there. So from the 1st of July 2023, that will push from 10.5% that it is now up to 11%.
Yeah, and I guess also as part of the budget, in line with this payday super, with the increase to super guarantee, that there is certainly some employers who aren't doing the right thing out there, that they've also thrown some additional resource towards the ATO to actually be investigating and being able to identify unpaid super earlier than it's happening now. So if you fit into that bucket in any way, shape or form, you can expect a tap on the shoulder from the ATO at some point in time.
Definitely.
The last super item that we have to cover is the $3 million cap. So this one's certainly been out and about a little bit already as far as focus from the media. The budget didn't provide any additional information than what has already been provided. So effectively what they've said is if a member, so it's per member, not per fund, has a balance of more than $3 million, and this is to apply from 1 July 2025, so we do still have a couple of years until it comes into play, that instead of the fund being taxed at 15% on the earnings, it will be taxed at 30%. Now, this is quite complex in how they're suggesting it will happen. The normal 15% will happen in the way that it's happening now. The additional 15%, they've provided a completely new formula, which is bringing in unrealised gains, which is where most of the controversy lies at the moment. As I said, they've not provided any further information on that, and it is currently under a consultation period. So we may or may not get some more information soon on that one. But I guess the action now is nothing. That there's no reason to jump in and pull super out to bring your balance under 3 million. Let's let the water settle and wait till we find out what the detail is before we go making changes.
Safe to say too on that one that there's quite a few industry bodies that at the moment are really pushing for a bit more certainty on that, and that it will be something that is actually easily tracked rather than making a bit of a nightmare for members. I think we've got one extra thing just on superannuation, just in regards to what we call NARLI, which is non-arm's length income and expenses. So what they've come out with and confirmed is that when you do work for your fund that you're qualified for, so accountants, lawyers, tradies, real estate agent, any discount provided to the fund is to be taxed at 45% on twice the level of the general expense from the 1st of July 2023. Now this applies for your self-managed superannuation funds. So just as an example, if a solicitor draws up a lease agreement for a property that's held in their super fund at no cost, if it would be charged at $1,000, this would be doubled to $2,000 for the purpose of the NARLI tax, and that would lead to a tax of $900 on that expense. So if there's something, if you have a self-managed super fund and you're doing some work for that and not charging proper rates, it's best you come and have a chat with one of us here and work out exactly how this will impact you going forward.
Yes, and that will be a fun one. That's something that I think it's been 5 years or so since they originally announced this legislation, and it's been through a number of suggestions along the way, and this I think is where it's going to land regardless of whether we like it or not.
Yeah, exactly. It's nice that it's come down from the 5 times tax, but still quite a hefty amount.
Yeah, absolutely. So the final one that we wanted to cover off was personal tax rates. So while there were no specific announcements in the budget last night with regard to personal tax rates, that means that the announcements that have been made previously and the changes that are meant to happen in future years for the moment are going to take place. So I guess the main one to note there is that from 1 July 2024, so we're still a good 12 months away from this, is that the bracket, which is currently at $45,000 to $120,000, which is taxed at 32.5%, is going to change to be a bracket from 45,000 to 200,000. So effectively it's amalgamating two brackets, and the tax rate will be 30% on that. So certainly something to be working out what effect that might have on employers and employees as we move into that 2024-25 financial year.
So that's our wrap up from MB+M. If you think that any of these changes affect you or you want to talk about them in some more detail, we've got all the fine print. So please contact one of us here at MB+M. You got anything you wanted to add, Anna? Anything we haven't covered?
I think that pretty much covers off on what we think is going to affect most of our clients. There certainly are other things that have been announced. So if there's something that you think might be going to affect you, feel free to give us a call and we can have a look at and have a more defined chat about how that might affect you in particular.
Good. Thanks everyone for watching, and we'll see you all again soon.
Thank you.